He also works with the research director to determine engagements and priorities, which means to a large degree that he is the intermediary between the business community throughout the Southeast and has direct firsthand knowledge to input into the system on feedback from the businesses, as well as the data from trade and the performance in transportation. He is also responsible for Jacksonville's branch board of directors and the district's advisory council on trade and transportation. So he provides regional input into the Atlanta Fed's monetary policy. Outside of the bank, I was very impressed and very happy to say that he has a major role on the Florida Council on Economic Education, again, to the creation of a pipeline of talent and equitable economic development into the economies surrounding our transportation improvements. He's also involved in disability, IN First Coast, the JAX USA partnership, and he's a member of Leadership Jacksonville class of 2010. As the vice president and regional executive since 2007, he has been responsible for law enforcement, cash services, check processing, and check adjustments. So he's also the contact person for finance in the region. In this capacity, he has been an excellent example and leader for how the Federal Reserve Bank operates. He's a native of Hendersonville, North Carolina, raised in Georgia, received a bachelor's degree in management in industrial management from Georgia Tech. He's also participated in the executive education curriculum at the University of Virginia and the Federal Reserve System's Senior Office Development Program. So please welcome Christopher Oakley for the keynote this morning.
Thank you, Kevin. Good morning, everybody. I hope you're able to see me, and I'm seeing my slides, so hopefully you are as well. First off, I want to thank, again, Kevin and Frank and the whole ITTS team for inviting us. I think this is the third time I've had an opportunity to interact with this group, so it's a pleasure to be back. I've got a lot to cover and not a whole lot of time, so I'm going to go pretty quickly. What I've got to start by doing, of course, is referencing the disclaimer that's at the bottom of this cover slide, which basically indicates that I'm speaking for myself. There's only one person that can speak for the Federal Reserve, and Chairman Powell, I guess, was not available to be with you today. So you're stuck with me, but like I said, I'm excited to be here. And let's go ahead and move on to the next slide. What I want to do today is very quickly just give you a reminder of the role that the Fed plays in the economy, go through some kind of basic educational information about the Federal Reserve for just a couple minutes, and then talk a little bit about the role that the 6th District plays, as Kevin mentioned, with an advisory council, and then get right into a view of what the national economy is looking like. So taking you back to Econ 101, we basically are charged by Congress with two things. That is, we are responsible for creating conditions that are conducive to maximum employment and to having a policy structure that results in price stability, so the inflation part of the mandate. If we go to the next slide, you'll see the first part of basically the team of policymakers that is involved with creating those conditions or attempting to create those conditions. The folks that you see on the screen here are the members of the Board of Governors. These are presidential appointees who are approved by the Senate. You can see currently there are 6 members. We have one of those positions that is currently vacant. I would imagine if you're not familiar with all of these folks, you're likely familiar with Jay Powell up there in the upper left-hand corner of the slide. The other component of the FOMC are the Reserve Bank presidents. So these are the 12 individuals that are selected by their respective boards of directors with approval by the Board of Governors, who serve as leaders for their various districts. And so you can see on the map there the 12 different Federal Reserve districts around the country. In the next slide, you'll get a sense for the 6th Federal Reserve District, which is the district that I'm a part of. Atlanta is our head office, and Raphael Bostic is our president and CEO. As you can see from the map, the overlap with the ITTS states is pretty significant. I think we've got 4 states in common: Florida, Georgia, Louisiana, and Mississippi. Kevin mentioned the Regional Economic Information Network. So if we can go to the next couple slides, Chris. Very quickly, I want to give you a sense of how in the Atlanta Fed District, we take on board information from the public. We do that in a number of ways. We have a survey group that goes out and surveys different constituents. The team that I have, you heard us talk about the Regional Economic Information Network, or RAIN for short. We work across the Southeast. We've made connections with somewhere in the neighborhood of 800 to 1,000 different contacts over the course of the last 10 years or so. And these are folks that are go-to contacts for us to gather anecdotal information about what's actually happening out in Main Street. And so as you look at that circular graphic there, you see public at the 12 o'clock position. That basically means our attempt to interface with these folks that represent businesses of all sizes, governmental entities, academia, nonprofits, and so on. So all the different components that are playing a role in the economy, we are trying to gather information from. Sometimes this information simply adds color to the policy position of our president. Sometimes we get a sense of a weak signal or an early read on something that's happening in the economy that's not showing up in the data yet. So of course, like all the other Federal Reserves, we have a team of economists that are looking at all the data that's coming in. This particular process allows us to add this color through these various stories that we're hearing from folks like you that are a part of this group. So basically, we bring this information in at the branch level. I have a board of directors, just like my colleagues around the district. We also gather information from our boards that in effect represent the public. That information is shared through our research department, which is our team of economists. We then layer on top of that the information from the Atlanta Board of Directors, who meets about a week after our branch boards. All of this is taken on board by Raphael Bostic, our 6th District President, as he takes that information and that insight to the Federal Open Market Committee, which is the policymaking body. Policy is made, and then of course, all of us as citizens are impacted by the monetary policy decisions that are made. And so the cycle starts over. This is obviously a very, very simplified version of how this process works. I would encourage you to take a look at the slides after the presentation and click on the link up there and you can watch a video. Normally I would show that to you, but we found that in Zoom world, that doesn't always work so well. So we'll leave that to you to do on your own. Going to the next slide, you'll get a sense of the types of organizations that are involved with our advisory council. So the district has a number of industry-oriented advisory councils. We've been fortunate out of the Jacksonville office to host the Trade and Transportation Advisory Council that is made up of entities in a number of different parts of your particular industry. And again, this just gives you a sense. I don't want to spend a tremendous amount of time on this because you guys are the experts on this, but I did just in the next couple slides want to give you a sense for some of the highlights of things that we've learned recently. So Chris, if we can go to the next slide, you can see our rail contacts are telling us that the year started off pretty robustly, even after some challenges earlier last year. Trucking has continued to perform very well. I mean, all of us have been benefiting from the work that our truckers have been doing as mainly essential employees during the pandemic to make sure that we're getting consumer goods delivered and so on. Interestingly, though, that we are hearing that as the vaccines are rolling out, will there be some shift later in the year or possibly next year from the focus on spending on goods back to spending on services? So that's something those contacts are telling us. And of course, we're continuing to hear about driver shortages that I know this group is very familiar with. On the next slide, air cargo. We pay actually a lot of attention to the passenger airlines because much of air cargo flies typically in the bellies of those planes that have passengers in them. And so, of course, that has been significantly impacted by the pandemic over the last year. While we are seeing some increase in movements of the vaccines, which has been helpful for some of these participants, the expectation for a return to pre-pandemic levels in this particular part of the industry is actually out about as far as any of our contacts, somewhere in the range of 2024 to 2026. And then finally, I wanted to mention quickly the port situation. Ports around the country, of course, have been very, very busy. The southeastern ports are no exception, seeing very, very strong container volumes. Again, oftentimes these being filled with different consumer goods and personal protective equipment and so on. But we're also hearing about congestion on certain ports, and this increased movement of goods through the ports in the latter part of 2020 and into 2021 has created some issues with containers, which impacts both importers and exporters as various members of the economy or parts of the economy are trying to keep these goods moving. So again, very quickly, I can respond to questions on those things if time allows, but I want to move on to the economic outlook and what we are seeing as the Fed. What I'm showing you here are just some highlights from the most recent policy statement. The last FOMC meeting took place in January. As you can imagine, we continue to recognize the impact that the pandemic is having, not just here, but around the world. The increase in cases that we saw in the latter part of 2020 and moving into the early part of 2021 has slowed the pace of the recovery. And I think you're going to see that in some of the charts we're going to show you in just a minute. Weaker demand has also impacted overall inflation, which has kept a lid on that, has actually kept it below what the committee's preference is from a inflation perspective. Again, another chart coming on that. Going to the next slide, we're just recognizing that overall financial conditions remain accommodative. Both the Monetary Authority, which is the Fed, with low interest rates, coupled with some of the fiscal supports that have been provided out there to provide relief to both individuals and businesses that have been impacted by the pandemic, has made this an accommodative environment. And we recognize that the path of the economy is very much dependent on the course of the virus. And this next slide, with a picture of Chairman Powell, just indicates that. Chris, if we can move to the next slide, you'll see where Powell is referencing that the overall economic activity remains below levels before the pandemic. And the path ahead, even as recently as January, continues to remain highly uncertain for the year, because even now, as we have vaccines, the rollout, the timing of the rollout, there are a number of things that we simply don't have certainty on at this point. And so you can see from a policymaker perspective, there continues to be a wide variability in terms of the direction that the economy could go as the year unfolds. So let's take a look at GDP growth, so overall growth for the country. This is a pretty phenomenal chart. As you can see, we had to adjust the chart this way in order to capture the impact from both the first quarter and the second quarter of last year, when we saw the initial impacts of the pandemic and the mandated closures in many cases on the economy. The different colors, by the way, and those vertical bars just represent different parts of the economy. So either contributing to growth if you're on the upper side of zero, or subtracting from growth, obviously, if you're below the zero line. And so you can see that in the second quarter, we were down into the minus 30s percentage-wise in terms of the impact on the economy. Recovered a healthy amount of that in the third quarter, and then again saw the pace of the recovery begin to slow in the fourth quarter, again aligned with some of the challenges that we had as case counts increased. On the next slide, you're going to see a picture of what one of several projections that the committee makes, and I really want to encourage you to seek this out. So every other FOMC meeting, so about once a quarter, the committee provides what's called the Summary of Economic Projections. And this is information that is available to everyone. It's part of the press release. And it gives you a picture of what committee members are projecting based on the information that they have during that particular period of time. And the charts, again, without spending too much time going into this, just give you a sense for the variety of views of the different committee members. So again, the governors and the Federal Reserve Bank presidents. And so directing your attention to this one, the most recent summary is from December. If you look at 2021, the median consensus of the participants is that we'll see growth this year somewhere in the neighborhood of 4%. But again, as additional information comes in, committee members will have an opportunity to update this. So it really benefits you to take a look at this each quarter when this information is released, so you can get a sense for at least how the individual committee members themselves are seeing, in this case, anticipated growth for the year. So if we go to the next slide, I want to talk a little bit about employment, one part of our mandate. January honestly was not a great month from an employment perspective. We added about 50,000 jobs, not a horrible number during normal times, but as we're trying to recover jobs that were lost in the early part of the pandemic, we would obviously like to see more and more people go back to work. And I think this is, again, reflective of the course of the virus and either mandated or voluntary closures that have taken place in different parts of the country. The unemployment rate actually did decline slightly, but I think that's due more to the fact that fewer people were looking during the month of January as compared to December, because that rate is dependent not only on the math that's involved with putting it together, but an element of that is actually the number of people that are actively seeking employment. So if we go to the next chart, you're going to see, I think something is really interesting. Again, in the different columns, the colors represent different sectors of the economy. We actually had to break this into two charts, because if you look there in March of 2020, which is on the far right-hand side of the left chart, you can see that we lost somewhere in the neighborhood of 1.4 million jobs, with about 700,000 of those jobs being in leisure and hospitality. As horrible as that was, we had to change the entire scale to capture the impact from April of 2020, when we lost nearly 20 million jobs in the course of a month. And in that case, 7.5 million of those jobs being in leisure and hospitality, again, due to mandated closures that took place across the country. Again, other parts of the economy, as represented by the different colors in that column, were also negatively impacted. And then you see in months beyond that, for the most part, growth up until we got into the latter part of the year, when we saw the momentum of growth slowing and even some contraction in the month of December. That's where you see that minus 227,000 jobs, and then a return to growth in January with the 49,000 jobs that were added. And I will mention that in January, transportation and warehousing lost about 28,000 jobs. So even in your industry, we're seeing some impact, again, I think primarily due to closures in different parts of the country. Moving to the next slide, again, just a picture of what the committee is seeing in terms of the unemployment rate. So for 2021, the committee is looking at unemployment continuing to fall. Again, we're at, I think, 6.3% now. The median consensus of the committee is that we'll get somewhere in the neighborhood of 5%, again, with continued lowering rates of unemployment over the course of the next couple of years. And then finally, I want to talk a little bit about inflation, the other part of the mandate. I mentioned stable prices. I want to pause on this slide for just a minute and draw your attention to the fact that we've got a 2% inflation rate objective. And so that is a number that the FOMC determined several years ago that they would target for inflation. And I like to take a minute to explain why 2% versus 0%, for example. And I think the reason for that, or at least one of the things that makes a lot of sense to me, is the fact that having a low inflation rate like 2% allows us to create conditions where folks are not impacted by the timing of purchases that they make. And so the example I like to give is, let's say you're a kid and you want to buy a bike, and that bike costs $100 today. Well, if that bike costs $100 today, or it costs $102 with a 2% increase over the course of the next year, would that impact your decision on the timing of purchasing that bicycle? And so I think the feeling is that 2% is low enough that it wouldn't impact that decision, but it's far enough away from zero that it gives us a bit of a cushion from a deflationary environment. central banks around the world do not have a lot of success in dealing with deflation. And you always want to see an economy growing by having a very low and moderate movement in prices. And so again, the committee decided that 2% was the number. What you're seeing there in terms of the colored lines are just three different measures of inflation. The story I'm trying to tell here is the fact that all of these right now are running below 2%, and they have actually for quite a long time. And so part of the committee's commitment is to continue to create conditions that will allow prices on average to move up to be around 2%. If a little bit over, that's okay. A little bit under is okay, but over the longer term to settle in around that 2% number. And again, if we go to the next slide, you'll get a picture of what the committee members are seeing is going to happen with inflation. Again, moving to 2021, it's looking like about 1 3/4, 1.8%, somewhere like that, and moving toward 2% over the course of the next couple of years. And I want to conclude with just a little information about where did the committee land in January. And so this is information that you already have, but of course the committee has decided to keep the target date for the Fed funds rate, which is the interest rate, the policy rate as we call it, at near zero. So this was the action that was taken right at the onset of the pandemic. We dropped rates to near zero, really taking a cue out of the lessons that were learned from the financial crisis a little more than a decade ago. By moving quickly, moving in a big way, and being very open about the actions that the committee would take. And so one of those, again, was dropping rates nearly to zero to create very accommodative conditions. And looking ahead, the committee thinks it's appropriate to maintain that level until we assess that maximum employment has been achieved and that inflation has not only risen to 2%, but is on track to moderately exceed 2% for some period of time. And that's actually a new policy position that was established through a framework change that was made in late summer of last year, where the committee more explicitly is saying we are going to be comfortable with allowing inflation to run a bit above or a bit below that 2%, sending the signal to the markets and to all of us that 2% was not a ceiling, but was rather a target. And you would allow the actual inflation rate itself to move again a bit above or below that particular target. Another policy action that was taken at the beginning of the pandemic and continues is what we used to call large-scale asset purchases. The press used to call it QE back in the financial crisis days, quantitative easing, but this is where the Fed basically is bolstering its balance sheet by purchasing treasury securities and different types of mortgage-backed securities to allow us to have some impact on rates on the longer end of the curve. And so if we move to the next slide, as I kind of wrap this up, I want to emphasize that the Fed is committed to keeping conditions accommodative for the foreseeable future. I love this quote from Chairman Powell. And even though this is back from last summer, I think it continues to be relevant today, where he says, we're not thinking about raising rates. We're not even thinking about raising rates. What we're thinking about is providing support to the economy. And if we go to the last slide, I think you'll see exactly what the chairman is saying there. This is a picture of what the participants on the committee think is going to happen with the Fed's fund rate for this year, next year, 2023, and then over the longer term. And so I like to emphasize here the word at the top of the slide is important. These are projections. These are not promises, because obviously the economy is what drives these decisions. And so each quarter, the members of the committee get an opportunity to provide updates on these projections. But based on what they are seeing today, all of the committee members, as you can see by all of those dots that represent the various members of the committee, are expecting no movement in the Fed funds rate. Going into 2022, as of the end of 2022, we're looking again at no movement by all but one, who thinks we'll be able to begin that return to some kind of normalcy at that point. But with more of the committee members moving, or at this point thinking that they'll be comfortable in moving the Fed funds rate in 2023, and then over the course of the longer run, getting back to a rate that's somewhere in the neighborhood of 2.5%. But again, when I look at this picture, what I'm seeing is a commitment by the committee that, given current economic conditions and the uncertainty related to the path of the virus, the Fed is doing its part to keep conditions as accommodative as possible to allow the economy to get back on its feet and recover from what has been a massive blow to the economy. And so finally, the next slide, and again, I think you're going to have access to all of these, has a couple more links. If you're interested in learning more about how the Fed is reacting to the financial crisis caused by the pandemic, you can see both the Board of Governors website there, as well as the Atlanta Fed's website. And I would encourage you to explore all of these. I mean, one of the great things about the way the Fed is structured is you've got the Board of Governors that oversees the 12 reserve banks, but in effect that results in 13 different collections of information that is available to the public. And so these, again, are just two of those, but all the different reserve banks are involved with this. And because you have members of your group that are in states that are represented by other reserve banks, you may want to explore those as well. So with that, I'm going to take a breath, and I'll turn it back over to Kevin to see if there are any questions.
Thank you, Chris. That was a great analysis. It looks very positive, but with some elements that are still struggling. The first question, Frank is going to help me with additional questions. I see one. When you talk to governments across the United States and in the 6th District, it's clear that they're going to be struggling with their tax revenues this year. And how they use transportation infrastructure as the tip of the spear to create commerce is something I think they expect and hope for. In your discussions with businesses, however, what is the feedback that you're getting in the pandemic? Are the businesses, do they want more support? Do they want to help with the pipeline of talent? Are they willing to participate in creating tax allocation districts, which would provide the match for funding? What kind of feedback are you getting from the business community in developing your research and database?
Yeah, great question. And thanks for giving me the opportunity to talk about that a little bit. It's been interesting, and I'm going to reference Raphael Bostic again, our president, who has described the state of the economy as a less than symbol. And what he means by that, if you can picture that symbol, you've got the upper part of the less than symbol and the lower part of the less than symbol. It was really fascinating to us as the pandemic was unfolding, the number of contacts that were actually not only performing at the level where they had been before the pandemic, which, by the way, the economy was really in very good shape ahead of the pandemic. But we saw a number of these, and these are, what have become known as the usual suspects. The home improvement stores and grocery stores and any type of goods related to being at home, those doing very, very well. And I think at the same time, at the individual level, you had folks like us, probably many of the folks in the audience, people that were able to relocate and work in their homes and basically not miss a beat with their own income, doing quite well, again, on the upper end of that less than sign. But then there were those that were dramatically impacted. And of course, in our district, it's hard to have a discussion on this without thinking about leisure and hospitality and the impact that the virus and the actions that governments took to deal with controlling the spread of the virus. It's difficult to think about that without thinking about the just many, many thousands and thousands and thousands of people locally. And then those numbers get bigger and bigger as you go out, who were impacted because maybe their job being a waiter or a server or working in a hotel, that those jobs were lost. And so the point I'm making, Kevin, is that we've heard very, very different perspectives on how the pandemic has impacted performance. And so to your question about governmental roles and support, I think that we have tried to characterize the fiscal policy decisions that have been made as relief. You know, a lot of times when you see a fiscal decision made, it's characterized as stimulus. But in this case, I think the ideal was really to provide relief or to provide a bridge to getting through the pandemic for businesses, particularly for those that were shut down, to allow them to have enough breathing room to make it to the other side. And of course, you know, fast forward to 2021, here we are. We're still dealing with a lot of these challenges. The current uncertainty seems to be around the pace of the rollout of the vaccine. So that's kind of part A of that. And then the second part of that is, will this vaccine hesitancy that we've all heard about among some people, will that be an issue that will impact us getting to herd immunity, which hopefully allows us to kind of begin or to commence a recovery in a much more rapid fashion? Is that going to be another roadblock, or will we get to a point where enough of us have had the vaccine that those that are currently uncomfortable will kind of come around and feel like it's safe and it's something that they are comfortable doing as well? So those are the types of questions that we're hearing now as companies are trying to anticipate how 2021 is going to unfold.
So you would characterize the response you're getting from the businesses as trying to survive and trying to figure out a process where they can take advantage of transportation to improve their own bottom line, their performance.
Yeah, as a matter of fact, I would go further in talking about the pivots that many businesses have made, and I've heard this described in a couple different ways. For some, it was an acceleration of trends that were already taking place, and for the group that is with us today, this movement to e-commerce, the way that the movement of goods has changed. We know that was already happening, but our contacts are telling us that the pace of that movement was accelerated by something like 4 or 5 years. And so that's created extreme stresses on the infrastructure, both in the private sector, as well as, to your point, the more broad transportation infrastructure that, of course, gets stressed by having, for example, more trucks on the road delivering goods, or more smaller delivery vans and vehicles in neighborhoods delivering goods. So as that rapid acceleration has changed, it's created a lot of questions. It's also created, as you suggest, some opportunities for those businesses that are able to deal with it. On the service side, which is probably not the biggest focus for this group, I think you're exactly right. I mean, we're looking at these supports as hopefully creating a bridge to survivability for these organizations. And I like to remind folks too that they're also being helped in some cases by private sector decisions. And so an example of that would be, let's say a restaurant that has had to close temporarily, getting some relief from their landlord for some period of time, basically deferring rents, for example. Those are other things that are taking place that are being helpful in this situation. But I don't want to minimize the stress and the challenges that many parts of the economy are continuing to face, and I think will continue to face until we all feel safe and being back out and interacting with one another, basically contributing to the economy in an in-person way versus sitting in our kitchens or living rooms doing it.
Thank you. There's another question on the bank's Trade and Transportation Advisory Council. Can you tell me a little bit about, or can you tell the audience a little bit about it? And there is a related question that this is a logistics cluster, that there's a lot that is occurring in Jacksonville where you are, and a little bit of discussion on maybe the logistics hub as well as the Bank's Trade and Transportation Advisory Council. What is that, and how does it operate?
Right. Yeah, again, this has been kind of one of the things that's been fun for me in my role because these councils didn't exist 10 or 12 years ago. And so we got the opportunity to look around our district and identify what are the various sectors in the economy that are really driving activity, not only in the Southeast, but importantly, that are representative of the national economy. And so Jacksonville, we raised our hand for this logistics oriented trade and transportation group for a couple of reasons. One, because I'm just personally interested in this as a major mover of economic activity. But importantly, Jacksonville, we're the home of CSX. We're the home of a rapidly growing port. You've got I-95 and I-10 coming together. So you've got a lot of trucking activity that takes place in this area. And so it seemed like a logical group to take advantage of some hometown contacts that we had. But importantly, Kevin, we go out throughout the Southeast in our recruitment of these folks. And I've actually, through interactions that I've had historically with folks in this group, when we've been able to meet in person, through networking, we've been able to expand our connections and bring people on board. And the role of this group is to serve as a sounding board for the industry. And so in normal times, it meets twice a year in person. And then between meetings, we go out individually with phone calls and gather information, sometimes as frequently as monthly. During the pandemic, as you can imagine, we've actually increased the number of formal meetings because we're doing them all virtually. But mainly because selfishly, we want to gather that information in real time. And as the economy is changing rapidly, we want to be able to contribute in a way that provides insight that we wouldn't have had otherwise. I'll mention one other thing about Jacksonville that the group might find interesting if you're not familiar with it. And while I think it's somewhat unique, it's not completely unusual. And what I'm getting at there is we've got entities like Amazon that are growing very, very quickly, that are creating all types of employment opportunities in our area. So just in Jacksonville alone, I think we're up to our 10th or 11th Amazon location. They're dealing with different types of goods as they work to make their supply chain more and more sophisticated. And that's just one company example of the kind of logistics boom that's taking place in this part of our territory. But I say it's not unusual because probably just about all of the geographies that are represented in the group that's meeting today likely are seeing something similar as we all change the way that we go about buying and consuming goods. The way that delivery infrastructure is having to change to support that, I think, is creating a lot of opportunities that didn't exist 5 or 10 years ago.
Let's switch to a different cluster industry and the feedback from business that you're getting. This question comes from Justin Ryan. In the ag and forest products sector, are you getting any headwinds when they will shift supply chain operations from a consumer focus back to a commercial institutional focus, back to big users and big volume? Yeah. What are you getting from that cluster industry?
Yeah, that's a great question. And it was, again, very interesting to watch the adjustment to that last year. And so, again, my understanding of the question is really getting at the delivering to a restaurant or to an institutional entity like a hospital or a school, different food supplies, for example, through the agriculture industry. It's very, very different than delivering to, my personal address and your personal address. And so it was interesting to watch, again, these companies and their related transportation partners figure out how to pivot to that. And I think the question is getting at how does that unfold? How does that unwind when we go back to whatever normal looks like? And I think the jury is still out on what that's going to look like. But I do think that in my conversations, I am constantly hearing how, first off, the logistics piece of business decisions has gotten elevated. So this is no longer taking place down in the bowels of the organization, but now logistics and supply chain issues are being discussed in the C-suite and in the boardroom. It's really elevated, I think, the stature of this industry, but it certainly doesn't make things any easier. And again, with so many unknowns related for how this year is going to unfold, I think it's going to be challenging, but I also predict that the lessons that were learned last year through that initial pivot will benefit the players in the industry as they unwind that and figure out, how do we go back to whatever normal is? I don't think it's what it was in February of last year, but I also don't think it's what it was in or what we are experiencing in February of this year either. So it's likely going to be some combination of those two things. And it will be interesting to watch how the industry adjusts to those demands.
Thank you very much, Chris. Before we close out and go to the next panel, I would just like to say that I think it's clear both from Chris's presentation and to the questions that people are hoping that transportation, which is already the connection to education, which is the link to education and to the economy and how we operate, how commerce operates. I think people are looking for transportation leaders to do more, to leverage their investments, to look at their own performance, not just in terms of beginning a project and ending a project, but its impact on the community in which it's being built. And that has to do with the current circumstances of the pandemic, the kind of poverty that we have, the kind of issues that seem to be very intractable. But I think we all agree that transportation is a way to diversify the economy, strengthen the cluster industries that we have, whether it's logistics or it's agriculture or it's innovation hubs, but bringing us all together to come up with the kind of public-private partnerships that are needed and that the Federal Reserve Bank obviously is advocating with its policies. So before Frank shuts me off, I'd like to say thank you, and thank you to Chris, and thank you to the questionnaires. And the next moderator, stay tuned for Vivian Cantasarius from the Georgia DOT on the National Transportation Outlook.
Great. Thank you.
Thank you, Chris.